Hello and welcome to this virtual conference on COVID-19 and central banking in Asia and the Pacific. This has been jointly organized by the ADB Institute and the Asia-Pacific Applied Economics Association. My name is John Byrne, a research fellow here at the ADBI. And for the next 3 days, we will feature paper presentations from researchers from academia, think tanks, and central banks. We will also feature keynote speeches from distinguished scholars. And as well as that, we will have a panel session of senior central banking officials on the last day. Today will be taking around 3.5 hours. We will post in the chat for your convenience the agenda and bios of speakers. For participants and attendees in general, please type your questions into the Q&A box, and we will try to get to those in the Q&A session after each session. So I would now like to go directly to the first item in the agenda, which is the opening remarks by Tetsushi Sonobe, who is the Dean here at the ADB Institute in Tokyo. So please, Dean Sonobe, go ahead.
Thank you, John. Good day from Tokyo and very warm welcome to the ADBI-APAEA virtual conference on central banking and the pandemic in the Asia-Pacific region. Since the outbreak of COVID-19, monetary and fiscal policies in the region have coordinated to support the economic recovery. Some Asian central banks engaged in quantitative easing, or QE, for the first time, helping to further address the impaired functioning of markets and the transmission of monetary policy. The measures adopted have helped to ease financing conditions with bond yields declining and exchange rate becoming less volatile. Today, fiscal policy remains accommodative and the monetary policy stance is still in expansionary mode, with central banks mostly refraining from increasing interest rates. Exports began to recover in 2021 as the pandemic became more contained, with supply chains repairing, while economic activity and growth were also supported by the rollout of vaccines. Export volumes from developing Asia during the first half of 2021 have exceeded their pre-pandemic levels. Many developing Asian economies have been able to capitalize on rising global demand during 2021, particularly from advanced economies. These developments have also been underpinned by effective fiscal and monetary policy responses to the pandemic in the region, which have helped to stabilize financial markets. Policymakers have done a very good job. However, I have to add that a degree of uncertainty remains in financial markets and that there are challenges ahead for policymakers to ingrain resilience into economic recovery, including the high oil price, shortage of semiconductors and other materials, and inflationary pressure. Of course, vigilance is needed as regards potential new strains of the virus as well. Over the next 3 days, eminent economists and scholars will present findings from their research on the monetary policy implications of COVID-19 and share their views on the way forward. There will be interesting discussions on monetary policy effectiveness and transmission, spillover effects of monetary policy, interaction between monetary and fiscal policies, and so on. In total, there will be 11 research papers presented, 5 keynote speeches from distinguished scholars and practitioners, and a panel discussion of senior central banking officials from the region on the lessons learned from the pandemic for monetary policy. We are delighted to have stellar keynote speakers joining us. Professor Bilal Acharya, Vice President Zhen Liu, Professor Sayuri Shirai, Chief Representative Siddharth Tiwari, and Governor Perry Vargero. Thank you very much. We are extremely honored and also excited to hear the views of these accomplished experts on monetary policy and their impressions of what we have learned from the pandemic. To delve more deeply into the topic, our final session on day 3 will be high-level panel discussion of senior central banking officials. We are delighted to welcome Governor Aziz Nival Cabral, Governor Benjamin Diokno, Deputy Governor Bam Bahadur Mishra, and Associate Director General Atsushi Takeuchi. I very much look forward to successful conference and a fruitful exchange of views over the next 3 days. I hope that we can learn further about the conduct of monetary policy in times of crisis and its role in contributing to stability in financial markets. Moreover, I hope that our conference helps to stimulate dialogue among policymakers, as well as supporting the further development of monetary policy research going forward. Let me now conclude my opening remarks and hand back to John. Thank you very much.
Thank you very much, Dean Sonobe. Before we have our first keynote speaker today, I would like to introduce Susan Sharma, who's a senior lecturer at Deakin University and also a representative of APAEA, who are our joint organizers today. As well as that, she is editor of the Emerging Markets Finance and Trade Journal, which will feature selected papers that will be presented at the conference over the next 3 days. So Susan, can I please introduce you to go ahead, please?
Yes, thank you. Thanks for inviting me. It's my honor to present remarks on emerging markets, finance and trade. Sorry, I'm not having internet at my home and I'm joining via my mobile phone. I would like John to just share my slides. Thank you, John. So I will just provide some remarks on emerging markets, finance and trade, and little bit information on this special issue that we are doing via this conference. You can move to the next slide. Okay, before I give some overview, we need to note that in January 2020, EMFT had a major change in their editorial board. And this editorial board, they had a set of plans of action in order to reform the journal. The main aim of this reform was to increase the visibility and make the journal more impactful. And the ideas that we have developed and the engagements that we have had over last 1 year has immensely been seen in article downloads, article citations, and so on with respect to this EMFT journal. So basically on this particular journal, as you can see, this graph provides statistics on article downloads from EMFT. So if you compare the downloads from last year compared to previous years, the change is quite immense. It's like 134% increase in paper downloads from the journal EMFT. You can move to another slide. This slide shows article downloads by country and regions, and as we can see, it's not skewed to one particular country. There are a lot of emerging countries. Even though the journal is on emerging market, you can see the second most downloaded papers, the second most common country is United States after China. So as you can see, it is widely or globally visible, and all researchers, let's say from Germany, USA, are also downloading our papers and citing. So this is really good news for us as well. So we can move to another slide. These are most downloaded articles in past few months. If you look at, I'm not going to go through each and every article, but basically if you see the title, you will see that this reflects most all these papers reflect on a COVID-19 pandemic. So EMFT was the first journal, like it was first in the rank in publishing the special issue on COVID-19 pandemic. So last year we have published altogether 3 special issues on the pandemic COVID-19, and the impact of those special issues are more visible via these citations. So as you can see, the most downloaded articles over past 3 years are simply those articles which were published on the theme COVID-19 pandemic, which form the part of the special issues. We can move to next slide. Okay, so in this slide, we can see the top institutions by downloads. As I have been saying, it's not skewed to one particular country. For example, the first one is Korea Council, then there's a Chinese university, then there is an Australian university, and so forth. So we can see the diversity in visibility of this journal. We can move to another slide. You can skip this, sorry, John. You can skip this. Okay, so this is the impact factor by year for EMFT. As I have been saying, the editorial board changed in January 2020, and you can see a big jump in the impact factor in year 2020 compared to previous years. So this graph clearly shows that the plans and strategies developed by the new editorial board has worked, because the main aim, as I said, was to increase the visibility of the journal and make it more impactful. So we can move to another slide. Top cited articles, this again, it's very clear. It is more similar to what we have seen in top downloaded articles. Most of these articles, again, in fact, all those articles are on COVID-19. As I said, whatever we have done in 1 year period, it had a great impact. And that's why we have seen such a jump in the impact of this particular journal. We can move to another slide. We can skip this. Okay, so as I have been saying, in order to increase the visibility or make it more impactful, we are visible on number of social media. Our presence is on different social media. Either you are in China, either you are in US, or in any part of the world, we are there. We can be connected via Facebook and other social media platforms. So this is what I would like to. I wanted to show that this journal, since the editorial board has changed, this journal has been growing with respect to their impact and with respect to their visibility, and also the quality of papers that we have published over last 1 year is it's quite good, because when you compare their citation, it's increasing on a daily basis. So that's a very good news, and I'm very hopeful that whichever paper we are going to select from this conference and publish in a special issue, these papers will be also highly cited and or highly downloaded in the future. So that with those remarks, I would like to conclude my presentation of these slides. However, before I just conclude, I would like to say, with respect to the current special issue, the papers which will be presented today, authors may have another 4 to 6 weeks to revise their papers based on discussant reports. And then after that, they can submit it to me, myself and John. We can read the papers and we can select the best papers from there, and then we will invite those authors to submit those papers to the journal EMFT, and further instructions regarding the submission and the process will be emailed to them after the conference. Thank you very much.
Thank you very much, Susan. Yes, so we're very happy to have the EMFT involved in the conference, and we will look forward to the publication of selected papers in that issue in due course. Now, actually, Susan, you are the chair of the session for the remainder of the day. So I'm going to hand the floor back to you to introduce the first keynote speaker of the day.
Yes,
So please
thank you
go ahead.
Thank
Thanks,
you
Susan.
very much. Just give me a moment. I'm switching from my PC and phone. It's a little bit annoying. Okay, great. Thank you. Okay, so our first keynote speaker, he's Professor Viral Acharya. He is a CV Star Professor of Economics at New York University. He was also a former Deputy Governor of Reserve Bank of India. Sorry, it's my great honor, Professor Viral, to introduce you and to welcome you in order for you to give a keynote speech to this conference.
Great. Thank you so much, Susan and John, for inviting me. I'll try and share my screen. Hopefully you can all see it. Just want to confirm you can see it, Susan and John?
Yes.
Okay,
Yes.
great. Perfect. So I guess my job is to talk a little bit about the Fed normalization and its likely impact on emerging markets. Are they ready, etc. It's one of those things where you know the risks, but how they play out, we'll find out when they materialize. But I see that there is great value in reminding central bankers and markets about the risks, because whether we like it or not, there is always a sense that this time is somehow different. And my experience in dealing with emerging markets and banking crises and external sector crises in general is that history may not repeat itself exactly, but it does rhyme. And ignoring it is usually at the peril of that country or the central bank by and large. So, of course, the context is that we had an extraordinary shock, one that perhaps practically no one foresaw until it started taking hold in January of 2020. The pandemic outbreak. Central banks and governments provided extraordinary monetary and fiscal support. Perhaps that was to be expected. Maybe for some, the support was more in scale and scope than they might have imagined. In the US, they call it the Fed's big stick, which is that Fed practically supported, every single market that was collapsing at that time, range of institutions from money market funds to municipalities, and both investment grade as well as some of the fallen angels. In some ways, these central banks acted as stimulators of last resort for the global economy, because when developed economies, central banks provide their stimulus, it means printing of the hard currency in the sense of injecting reserves into the global economy. And these reserves search for yield and reach the shores of emerging markets. It could be in the form of government borrowing, corporate borrowing, borrowing for speculation, etc. And as we stand now, these central banks are getting ready to exit from their support. Some have already announced normalization. Some have hinted and surprised the markets, saying they will raise rates, but then backtracked. But either way, interest rates are rising in the developed economies. And the big question is, are the emerging markets prepared? I just want to show you a few things about what happened over the last 2 years, what happened during the most recent such episode that happened with the Fed normalization in 2013, and what do the metrics suggest where the risks might be going forward. So at the outbreak of the pandemic, the emerging market sovereigns were expected to be hit harder. And there were a variety of reasons. They have weak public health systems. They had limited fiscal space in particular, a point I'll come back to. They had outflows due to flight to quality. In fact, it's emerging more and more through data that the stress in the US Treasuries market in March of 2020 was not just because mutual funds and leveraged hedge funds were liquidating their treasuries position, but actually the national central banks all over the world were also wanting dollar reserves in order to stabilize their currency. And to do that, they were selling their holdings of the US treasuries. So, they were facing outflows, so they had to stabilize their currencies. Some of these EMs are also dependent on international demand. They are exporters, net, and they also depend on oil prices, which, during the pandemic, because of a variety of supply chain and other reasons, first collapsed, but then eventually rose. And if you look at the credit default swaps market, just to get an index from there, the cost of hedging credit risk of emerging market sovereigns rose from sort of relatively benign levels of around 150 to 200 basis points. It rose about at least by a factor of 2.5 to 450 basis points at the peak of the outbreak. And then you can see there has been remarkable stabilization by end of 2020 to pre-pandemic levels. And this is something I'll also come back to later. And how did all this come about? One assessment is that the Federal Reserve, as it often does, it acted as a global lender of last resort. So not just as a lender of last resort with its big stick for the US markets, but it also set up dollar swap line facilities to several foreign central banks. Of course, there was a reduction of rates, but more importantly, not just direct pumping of dollar liquidity into the central banks elsewhere, but also the dollar liquidity, because of extraordinary rate cuts, started chasing emerging markets for the higher yields. Of course, EMs took their own stabilization measures through the central banks and government responses, and for a while, things stabilized. And to just put it in perspective that this is a global financial cycle, and I think I want to stress this point, that while EMs may have their own defenses, ultimately they are tied, whether they like it or not, to the decisions of the US and the Fed especially. And you can see this most notably through this measure, which has been found in a lot of finance research to track the emerging markets pretty well. And that's a simple measure of the volatility index, or the fear gauge of the United States stock market options. So it's a measure of implied volatility. And you can find that this measure, which is on the right axis, it reached a peak of about over 100%. At its peak. It's on the left axis. It reached a peak of about 75 to 80%. It had reached 120% at the collapse of Lehman Brothers. And if you track an exchange rate index of emerging markets, where a higher index means depreciation, you can see that it pretty much behaves in line with this VIX index, that when VIX increases, the emerging markets get destabilized and their currencies depreciate because of a flight to safety to the US dollars. As this uncertainty is diffused through central bank and government measures, so the VIX comes down, the emerging market depreciation also decline. In other words, they get their appreciations back, and then they stabilize. So I want to highlight this, that emerging markets are tied not just to their own domestic cycle, but importantly to a global financial cycle. So why is this point important? It's important because the US stimulus has been very large, both monetary as well as fiscal. Some would argue that on fiscal side, it is as big as the New Deal stimulus after the Great Depression. The monetary stimulus was about $120 billion being pumped every month. That's sort of much rapid and extraordinary compared to the global financial crisis. And it has worked in the sense that the US is growing faster than the rest of the world. Some of it has to do with vaccinations, but US is no longer the fastest country being vaccinated. There are others, but it's also the scale of the stimulus, which is pushing demand at a very fast pace, while the pandemic is still playing out in other parts of the world, and those supply chain problems mean that demand is actually rising faster than the supply can catch up, and inflation has just recorded a very high print of 6.2% in the United States. And inflation expectations are rising very, very sharply. I can tell you that everything I buy, I just bought a few winter gloves today. Everything is remarkably expensive compared to where things were 2 years back. And I think I want to mention this point about expectations because ultimately that feeds into the yield curve. And you can see that just by even non-parametric measures, so sort of non-CPI basket measures, such as whether inflation is on the mind of the US consumer, it turns out that US consumer has never searched on Google for inflation as much as since 2008. Like 2021 is the peak year in terms of inflation searches because it's there, it's patent. In fact, I would say that the inflation I'm experiencing in my basket is far in excess of the 6.2%, which is the measured inflation of the last month. My neighbor works in the business of furniture and upholstery, and he says they can keep raising prices to whatever they want. It's a high-end furniture business. People are buying houses where they're going to move into next August or even the summer after. They all want commitment for delivery of furniture, and they are willing to pay the price that the furniture store names. So, there's very heightened demand, and, the supply is very, very stretched because of the global supply chains not having normalized fully. Now, you could say that's just a pandemic problem, but when a problem typically in statistics or economics or econometrics plays out for more than 12, 18 months, it starts getting roots. And partly it's because it's affecting inflation expectations. And I think the Fed is going to have to do something about it. Now, as these inflation expectations are entering the government borrowing costs, so the blue line is the US yield. Today it's at 1.62%, and it's been ratcheting up there. You can see that the emerging market local currency government bond yields since January 21 have also started moving in lockstep with the US yields. And I think this is again an important point, which is that as an index, emerging markets look as though their monetary policy is basically tied to the monetary policy of the United States. Now, this may be because some of them have proactively raised interest rates, but I think it's partly because they are all actually absorbing the flows that came from the US when the blue line was very weak, when it was very low. That meant that the global reserves were flooding into the emerging markets. I'll show later on that they've also issued a ton of debt in 20 and 21, far more than someone would expect in a pandemic kind of scenario in terms of stress, but they have issued a lot. A lot of these carry trade flows are now going back or requiring higher yields for staying in. And that's partly reflected in the orange line moving in lockstep with the blue line, because the carry traders are saying, listen, for me to stay, you have to give me the same yield as the yield on a US Treasury. So the question is, will the EMs face a sudden stop if the US rates keep rising? And what can the history tell us? So, of course, unlike a lot of other episodes, we don't have to go back too far. We had such an episode just in 2013, the taper tantrum. And as we know, we were coming out from a global financial crisis. The Fed, BOJ, ECB, BOE, they all crashed their rates from whatever levels they were and promised to keep them extraordinarily low. By 2013, things had improved. And Chairman Bernanke said, we'll have to scale back our liquidity easing, quantitative easing programs. And just the sheer mention of normalizing sent shockwaves, because all these carry trade money that had flown into emerging markets started pouring out, creating dislocations in the bond markets. Ultimately, in June and September, Fed had to delay tapering. Now, one thing I want to stress is that at that time, Fed was not experiencing above normal inflation. and therefore Fed had the bandwidth to actually push back on its normalization plans. Right now, inflation is running way ahead of the target that Fed is mandated to try and achieve. And this restricts, in my opinion, the space of Fed, given its national mandate, to slow down its normalization, even if there is an emerging market spillover this time around. Okay, that I think one should not assume that Fed will simply scale back normalization as it did at time of taper when the emerging market upheaval played out, because it has to ultimately respect its national mandate. So what happened is that, as you can see there, during 2002 to 2008, emerging markets were not the recipients of these global flows. Global flows were more between advanced economies, but post the quantitative easing and the extraordinarily low rates adopted by these developed economy central banks, emerging markets became big part of global capital flows. They became even more entwined with the global financial cycle. And what was the consequence of that? You can see that on the right-hand side, which is standard deviation shocks to capital flows, that during May of 2013, the taper tantrum they experienced, many countries experienced between 1 to 2 standard deviation outflows. In case of a couple of them like Thailand and Turkey, it was even larger. And in June, which was the first month after the taper announcement on 22nd May, you can see that the outflows in many cases are in fact between 3 to 6 standard deviations. Okay, so this is at a time when perhaps we were not used to normalization, but I want to stress that this was at a time when Fed was not facing a red hot US economy, which seemed to be showing signs of growthflation, as they are calling it, overheating, growth, and excessive inflation. Even at that time, emerging market default risk as priced in the credit default swap markets rose. You can see there in the middle of May 2013 there, that there is again a rise from 200 to 400, 350 plus basis points. So it doesn't take much. It doesn't take much time, and it doesn't take much. It just takes sort of sometimes just an announcement for this to happen. Right now, of course, people are anticipating the normalization, but what is not clear is whether Fed will have to accelerate, in fact, the pace of its purchases, as has just been signaled over the last week by a couple of members of the Board of Governors, that the red hot inflation means that there is a case for actually increasing the pace of the taper that they were planning. Now, the question is, how does one put some structure on this? So I just wanted to wear my academic hat for a short while and say that during taper tantrum, a good measure of stability, which I found in my work with Arvind Krishnamurthy of Stanford GSB, was a measure of liquidity of the EM. So what was a measure of liquidity of the EM at a consolidated basis? It was his FX reserves relative to its short-term external debt. Okay, and sometimes countries feel very good if their FX reserves are very high, but we know right from Guidotti and Greenspan that that's not a good enough view. You have to scale your FX reserves by your short-term external debt. And why is that? Because very often the FX reserves are built precisely out of your short-term external debt. So even prior to the taper tantrum, emerging market central banks and sovereigns had built up their FX reserves. Why was it not sufficient? Because actually the short-term debt had also risen quite significantly over that period, as you see on the right-hand side. And so a good measure is to actually look at reserves relative to your exposure, which is your short-term external debt. So we do this and we find that countries which were more liquid actually had lower depreciations. They had better stock market performance in terms of lower stock market corrections, and their sovereign credit spreads widened less during the post-taper period of June 13 to October 17. So on the top left, you see that countries which had more liquid. So on x-axis in all of these figures is liquidity of the sovereign. This has some sovereigns which are from Asia-Pacific and some that are from elsewhere. And you can see that if you are more liquid, your sovereign spread widened less. So this is a negative slope. Your stock market return is positive. So if you were more liquid, you had less of a correction. And your currency appreciation was stronger. Of course, here they are all negative. So it means that your currency depreciation was, the currency appreciation was more, your currency depreciation was smaller if you were more liquid. Okay, and now the key question is, will this time be different for EMs? I have to say that there is a sense of a bit of a calm for my comfort globally. But I think the risks look very large, and I'm worried that EMs, while they look more liquid compared to the last time, their fiscal situation may not be as great. So I'll skip these things on outflows. I just want to just mention it in the passing that outflows have been volatile through most of 2021. But a big problem is the inflation credibility, which is that the inflation has been running high relative to the policy rate. So real rates are very negative. If you look at it on the right-hand side, though, one might conclude that perhaps for most countries, this is from a work by Barry Eichengreen and Poonam Gupta and Chaudhary, who are focused on India. So you'll see an India bar, but I didn't mean to specifically highlight India, but it's borrowed from their research. And so the graphs are highlighting India. But what you see is that even though inflation is high, it's lower than what it was during the taper tantrum. So on that front, maybe things are relatively okay. Current account balance also looks better. The blue bars on the left are lower than they are in the black dots, which were just pre-taper tantrum. And reserve adequacy, the blue bars looks higher for many countries than it was in the past, though that's not true for Turkey, that's not true for Argentina, and that's also not true for some of the Asian countries. As you can see there, Malaysia and Indonesia have a reserve adequacy which is actually weaker than it was at the time of the taper tantrum. For countries on the right, it's actually higher. But the real elephant in the room to me is the fiscal situation this time, because if you look at this graph on the left, you can see that the emerging markets have just been levering up since the global financial crisis. The red bar has just gone higher and higher. At the onset of the pandemic, they issued even more debt. And you can see that emerging market debt right now is way above their any level that they had achieved relative to their GDP. It's in excess of 65% debt to GDP. You can see on the right-hand side that both in 20 and 21, they have done record bond issuance. Of course, this has been partly feasible because of the Fed acting as a global lender of last resort. And what that has meant is that debt as a percent of GDP in these blue bars is actually above the black dots that were there pre-taper. Okay, so there is one metric on which emerging markets look more vulnerable than they were pre-taper, and that's on their debt to GDP. If you move now to the right-hand side, if you look at that external debt stock as a percent of their GNI or GDP, again, for most countries, actually, the situation looks worse than what it was pre-taper. Okay, and I think this concerns me, which is that it's possible that this time around, even though in 2013, I found that the relevant metric was reserves adequacy to short-term debt, my concern is that countries look much worse fiscally, and that the risk this time may not be linked actually to the reserves adequacy, but it may be linked to the risk of downgrades. Focusing on Asia Pacific in particular, you can see that the yellow line, which shows the average rating index by region, the yellow line is for the Asia Pacific EMs. It's been stable, but it's below investment grade. And if you go to the right and focus on the second column, which is the Asia Pacific countries, you can see that 27 countries there are in the triple Bs. They are just at the cusp of investment grade. I think rating agencies have been very accommodating of countries during the pandemic, but can they really continue to do this if the external sector tightens up? They have to keep raising their rates. That may require that they will have to raise their taxation, and that would mean tighter rollover conditions for these countries. And I think that's my primary concern for the Asia Pacific. that there may be a risk of fallen angels in the Asia-Pacific EMs. Turkey and Argentina look vulnerable. They always do, but Turkey looks extremely vulnerable on pretty much any count you look at it. Historically, my experience as a central banker was that there was always a contagion from any EM on the general EM asset class. How will all this play out? We'll have to wait and see. But I think if I was a central banker in Asia Pacific right now, I would start getting the governments to think about what may be some measures to ensure that they look fiscally better in the coming months. Let me stop there, John, and take some questions if there's time.
Many thanks, Professor Acharya. That's a very informative talk. Now it's open to the audience for question and answers.
I can already ask a question, if I may, Susan.
Yeah.
Yes, thank you very much, Viral, for this presentation. So basically, you're quite concerned about a potential repeat of the taper tantrum this time around due to the issues that you mentioned. But I think things are a little bit different this time around. For example, in 2013, of course, the exchange rates in many parts of Asia was overvalued. So this allowed more space for sharp reactions to capital outflows on the exchange rate. As well as that, you mentioned the issue about current account positions being more favorable this time around. And I think a key indicator related to that is the level of external debt that's denominated in US dollar, which is also much lower this time around. So this, of course, would make the economies in Asia much less vulnerable to interest rate rises in the US and appreciation of the dollar as a result of that. So I wonder, my question, I suppose, is, are you being a little bit too pessimistic in your view that we could be in store for another round of taper tantrum? Particularly as well, I would say that over the last few weeks, we saw a rather muted effect by markets to the announcement by the Fed that it would in fact start tapering very soon, I think in December. And also, of course, they have their new inflation targeting, average inflation targeting regime in place, which gives a little bit more space for interest rate rises. So I just wonder what your thoughts are.
Yeah, there's a lot in there, but maybe I'll make 3 points. First, I think one aspect which I think is very different from taper tantrum is that Fed ultimately did not normalize after the taper tantrum. They pushed it off by several years. And that's because the inflation levels in the United States gave them the bandwidth to do that. Of course, they factored in the spillovers, but basically factoring in the spillovers did not do a great violation to their national mandate. Right now, that is not the scenario. I think even though the transitory inflation camp, one cannot say has yet been completely sort of dismantled by the incoming prints of data. There's still a view that maybe this is all transitory. I think it's becoming harder and harder to not price in some risk of Fed having to taper, not just taper, but taper faster than what the markets might have anticipated so far. So I think that's something to keep in mind, that Fed may not have the room to factor in the spillovers yet. If it spills back to the US economy, of course, then it becomes a part of the national mandate, and then they would have some room there. Second, I want to stress that I think the current account deficit numbers look all right, but I think the real rates are quite negative in most EMs right now. And I think both debt as well as external debt stocks to GDP are actually higher for many countries than pre-taper. So I think it's the fragility of the debt, the risk of downgrades, and the fact that many countries are right at the cusp of the investment grade rating that gives me a little bit of pause. I think my sense is that the metrics that may play out this time around for discrimination in investors between countries may be slightly different. It may have more to do with debt to GDP and risk of becoming a fallen angel. The last point I would stress is that I didn't say this very explicitly, but My sense is that equity markets seem in tremendous froth because of the real negative rates. Generally, we have thought of equity capital flows as being sort of long-term permanent capital flows. I'm concerned that this time around, because of real negative rates in fixed income markets, equity markets could be actually the fickle hot money flows that may unwind if there is actually a faster than anticipated normalization. As I said, I am actually trying to paint. I don't mean to say I'm pessimistic. I'm just painting a stress scenario because I think everything looks in the markets a bit too calm relative to what is actually measured and experienced inflation on the ground for the US consumer. I think many economists like Jason Furman from the previous administration, Larry Summers, and several others like John Cochran at University of Chicago, they are actually surprised that the Fed isn't actually giving more primacy to its mandate. The more the prints don't normalize, the more will be, the buildup of the pressure on the Fed to get back to its national mandate. Because, there is no sense in which US is right now at the risk of a deflationary pressure. US economy is booming. I just walked on 34th Street to Macy's right now to do shopping. US consumerism is booming. I've never seen consumerism as active as it was over the last 6 months.
Thank you, Professor Acharya. I can see two more raised hands, but just because we are already over the time, I'll continue with the next session. And I'm sorry, Dr. Liu and Dr. Bera, you can maybe use the chat box to post your question, and Professor Acharya will be able to answer your questions via the chat.
That's good.
So let's...
Thank you, John. Thank you, Susan. Thank you, everyone.
Thank you. Let's continue with the session one presentation. So our first speaker is, the first paper is on US monetary policy spillovers in Asia and the Pacific, and the presenter is the senior economist, Dr. Elif.
Apologies, I had to unmute myself before I share my window. Share screen. Can you see my screen?
Yes.
Thank you. Thank you very much for the opportunity to present our paper in this extremely relevant conference. This is joint work with several colleagues from the IMF, and usual disclaimer applies. The views expressed in this presentation are mine and should not be attributed to the IMF. Our paper is on US monetary policy spillovers, and it was extremely interesting to hear the keynote speech by Real Acharya on this same topic. So with that, I'll start my presentation. Interest rates in the US have been volatile and increasing recently as the Fed started to normalize monetary policy. But the path of US interest rates remain highly uncertain, with markets expecting a faster pace of policy rate increases than implied by the FOMC dot plot that you can see on the right-hand side. And this is as of the last FOMC meeting in September, and since then, the market expectations have moved rate hikes even more forward. So, and the usual concern is that a faster than expected increase in US interest rates could derail basically the recovery, especially in emerging markets, by leading to an ill-timed tightening in financial conditions. So in this paper, we focus on two factors that may be relevant in the current conjuncture. First is, again, related to the uncertainty that I mentioned, is the fact that there are potentially several drivers that are relevant for the outlook on US interest rates. And spillovers would presumably depend on what those drivers are. For example, if it's expansionary fiscal policies in the US and pent-up demand due to the pandemic, which is pushing up demand and leading to a faster normalization of monetary policy, the implications could be different from if the Fed is responding to a supply side driven increase in inflation and adopting a more hawkish policy stance to rein in these inflationary pressures. So in other words, why the Fed raises interest rates could matter. The second is the weak and uncertain economic prospects in emerging market and developing economies. While growth is projected to rebound strongly this year in emerging markets, there's concern about the strength of the recovery going forward, and potentially the state of the business cycle in other countries could matter for spillovers for various reasons, including the balance sheets and how they come out of the COVID crisis. The policy space that Viola Chari also mentioned is again could depend on the business cycle in receiving countries. So more concretely, we try to provide evidence on both financial and real spillovers from US interest rates. For financial spillovers, our focus is on high frequency movements in financial variables in response to US monetary policy shocks, which are also identified using high frequency movements in US interest rate futures around FOMC dates. We see this analysis providing complementary evidence on financial spillovers, which of course has already received much attention in the empirical literature. For real spillovers, we have three contributions. First, we study these spillovers not only through the first moment effects, but also the second moment effects on output investment, and in particular, how US monetary policy shocks could affect growth at risk, perhaps through the similar channels as the growth at risk analysis that Adrian and co-authors have popularized, and then sort of the amplification through financial frictions. The second is that we look at dependence of spillovers on the state of the business cycle, and to our best knowledge, this has not been explored earlier in the literature. And third, we look at the role of different macroeconomic shocks as drivers of US interest rates, differentiating between demand, supply, and monetary policy shocks. So moving on to the empirical methodology, first starting with financial spillovers. We use an event study approach where we focus on high frequency movements in financial variables and link them to high frequency movements in US interest rates around FOMC meetings. For the US, we use movements in interest rate futures within a 45-minute window around FOMC meetings. And in the results that I will present, we in particular use the 6-month ahead future on 3-month Eurodollar deposits, but our results are robust to alternative measures. In terms of financial variables, we consider a range of indicators, including short and long run bond yields, the MBI, the logarithm of the benchmark equity index, and some measures of capital flows. For these variables, we look at the change during a 2-day interval between the day after the FOMC meeting and the day before the FOMC meeting. And using high frequency movements, interest rates ensures that the measured monetary policy shock only reflects the unanticipated component of monetary policy, and using high frequency movements in financial indicators allows us to more accurately capture the impact of US monetary policy on foreign countries' financial indicators. Our country and time sample vary with the indicator of interest, but typically covers 21 emerging markets and 26 advanced economies. Turning to results, we find that US monetary policy surprise is associated with higher bond spreads, both in the short and the long end of the yield curve. And for different groups of countries, here we look at advanced, emerging market, and Asia-Pacific countries. More specifically, 100 basis points positive US interest rate surprise is associated with a 36 basis points increase in the 10-year bond yield for the emerging market sample. But the impact on the one-year bond yield is lower and is not significant. The response is also significant and large for the emerging market bond index, increasing by 60 basis points. For Asian emerging market economies, the impact is slightly larger for both the 1-year and the 10-year yields, and is statistically significant at about 45 and 55 basis points respectively. Spillovers to domestic bond yields is also fairly high and significant for the broader advanced economy sample, with the estimated impact larger at the 1-year maturity. So that's an interesting contrast with the emerging markets. US monetary policy shocks also have significant effects on domestic equity prices. Equity prices declined by about 4% in the broader emerging market and Asian emerging market samples, and by about 5% in the advanced economy sample, and by 7% in the Asian advanced economy sample. We also look at the impact on capital flows, again, focusing on movements within a 2-day window. Here, the coverage of daily data is, of course, is not perfect. So our estimates are less accurate. We find the expected sign, but for total flows, the impact is not significant. For equity flows, we have a more significant estimates for both the emerging market and the Asia-Pacific sample. And another thing that we do is we look at the difference in the impact between before and after financial crisis. And here we're focusing on the 10-year bond yield, which for which we have a broader sample of countries. We find the sensitivity of long-term bond yields to be higher after the financial crisis for both the emerging market and the advanced economy sample, with a significantly higher sensitivity for the emerging market economies. And in the case of Asian countries, for example, the estimated impact doubles from 20 to 40 basis points in the post-global financial crisis period. Now I will move on to our analysis looking at real spillovers. Here we move to quarterly frequency, and we use quantitative regressions and Georgia's local projection method to estimate the effects of different US macroeconomic shocks on the distribution of real GDP and investment over different horizons. Our panel data is composed of 62 advanced and emerging market economies. We estimate this regression for different percentiles. Here we focus on the 50th percentile or the median, and the 5th percentile to capture the left tail of the distribution. Our estimate of interest is the beta coefficient here. And before I show you our results, I will discuss very briefly how we estimate the US shocks. So for this, we use a structural VAR model for the US, which we identify using a combination of instrumental variables and sign restrictions. So the SVAR has, it's a pretty standard VAR, including industrial production and the consumer price index, the excess bond premium, and the 2-year bond yield to better capture sort of the forward guidance of component of monetary policy. The monetary policy shocks are identified using high frequency movements in interest rate futures around FOMC meetings as instruments. And this is sort of a similar to Gertler and Karadi 2015. And the identification relies on relevance and exogeneity conditions for the external instrument. And our first stage regressions confirm instrument relevance, and exogeneity follows from the assumption that high frequency movements in interest rate futures around FOMC meetings are driven primarily by the monetary policy shocks. To identify demand and supply shocks, we rely on pretty standard sign restrictions. In particular, we assume that the effect of demand shocks on output prices and interest rates have the same sign, while on the other hand, supply shocks have opposite effects on output and prices. And just to give you a sense of what the SVAR model, the impulse responses look like, we show impulse responses to demand, supply, and monetary policy shocks here, and to a 1 standard deviation shock. So 1 standard deviation positive demand shock, which increases output by 0.5 percentage points, increases prices, and a 2-year bond yield, as assumed in the sign restrictions. A 1 standard deviation positive supply shock initially increases industrial production by about 0.15 percentage points, increasing over time to about 0.5 percentage points in the medium term. The supply shock reduces prices and has a small negative and insignificant impact on interest rates. Finally, 1 standard deviation monetary policy shock increases the 2-year bond yield by 25 basis points, has a small insignificant impact on prices, and reduces industrial production. So we use our SVAR to estimate the structural shocks of interest and aggregate them to quarterly frequency to study their dynamic impact on other countries in the panel quantile regression setup that I just explained earlier. So here, showing you the results of the impact of a 1 standard deviation monetary policy shock on the median of output and investment over time. This is pretty standard result, consistent with other studies. An unanticipated exogenous US monetary policy shock reduces output and investment significantly, with the effects significant typically over the short run, with more persistent effects on investment. And the spillovers are quantitatively large. The average impact in the first year on output and investment is minus 0.1 and minus 0.4% respectively, which corresponds to an impact of minus 0.4 and minus 1.6% in terms of the impact of a 100 basis points increase, or 100 basis points shock to US interest rates. Now I would like to focus now on the estimated impact of demand versus supply shocks. This comes back to the issue why the US interest rates may be moving, or the endogenous response of interest rates to macroeconomic shocks. On the left-hand side, we show the estimated impact of a demand shock that increases output and interest rates in the US. As you can see, the near-term impact of the demand shock on foreign economies' output is actually positive in the short term. But turns negative in the medium term. So the near-term positive impact would reflect the offsetting positive impact of the trade channel, perhaps associated with a positive demand shock. What is less clear is the negative impact in the medium term, which could reflect various things, among which perhaps the domestic policy response. So that's something that could be playing a role here. But I would like to contrast that with the response to the supply shock. Here, the supply shock response is sort of gradually builds up in the medium term, following a similar path to the US output response to the same shock. And it's important to note that typically, in response to supply shocks, US interest rates have not again moved that much, but we see large spillovers also from supply shocks in the US on other countries. And next, I would like to focus on the.
Sorry, Dr. Sorry, Dr. Elif, you need to conclude in next 2 minutes.
Okay, sounds good. I will do that. Thank you. So this is showing the impact on the distribution of monetary policy shocks. And the point here is that a positive value between the 50th and the 50th percentile coefficient estimates suggests that the shock has a larger effect on the left tail, and therefore increases the downside risks to growth. And again, we find evidence for that. And again, this could be driven by, again, the financial frictions basically amplifying the shocks and leading to larger effects on the left tail. The last set of results I would like to share relate to the dependence on the domestic business cycle, the dependence of spillovers on the domestic business cycle. We model this following, using a smooth transition function and follow Auerbach and Gordon-Shkanko and Tenreiro and Tavaites. And we model it so that the spillovers depend on the growth momentum in the economy relative to its long run trend. I will not go into the details, but basically here we show the response to U.S. monetary policy shocks for the different these two recession versus expansion states. And clearly we see an asymmetry in the spillovers where the impact during an expansion state is very short-lived, and output impact is in fact positive beyond the medium term, whereas in a recession state the impact is more persistent and negative in the medium term. And we explore potential reasons for this. One could be that financial spillovers are amplified. The elasticity of financial tightening could be larger in recessions, and we find some evidence looking at this from the capital flows. The capital flows seem to be also more severely affected in a recession state. And we also look at potentially the role of policy space, and we do some simple regressions looking at the probability of the policy rates being close to the zero lower bound, and we also look at the impact of the fiscal balance and how our sort of our states, business cycle states, variable F affects these in our sample of countries, and we find that indeed they are the fiscal balance deteriorates when there's when it's in a recession state, and the probability of being close to the zero lower bound increases. So with that, I'll conclude. We find potentially large financial and real spillovers from US monetary policy normalization, and with downside risks to growth and investment. And this is amplified in weak economic conditions, potentially reflecting reduced policy space. And we also find that the source of the movements in US interest rates matter. And I'll stop here in the interest of time. Thank you very much for your attention.
Thank you, Dr. Elif. That was a nice presentation. I would like to welcome Professor Chow to discuss your paper.
Yeah, thank you, Susan. Please allow me to share screen. Can you see my screen?
Yes, we do.
Thank you very much. Yeah. Okay. Good morning from Singapore. Thanks to the organizers for inviting me to discuss the paper presented by Elif, which I enjoyed reading very much. Sorry, can't seem to move my slides. Okay. I'm sure you will all agree with me that this is a highly relevant paper as the US has emerged from its monetary policy accommodation adopted since the COVID crisis. But more importantly, if the tightening of the monetary policy is driven more by inflation concerns rather than US economic recovery, this, as shown in the paper, is associated with large negative cross-country spillover effects. So it is pertinent to assess the impact on regional economies given the taper tantrum experienced in 2013 and the uncertain pace of the ongoing US monetary policy normalization. Section 3 of the paper works out spillovers on financial conditions by running panel regressions to estimate the impact of US monetary policy shocks on two-day changes in other countries' key financial variables. It uses monetary policy shocks from Gerkanek, which measures surprises in high-frequency interest rate futures within a 45-minute window of FOMC announcements. So the question I have is, how do these shocks compare with the implied monetary policy shocks in Section 4? Why not use the same set of surprises in both sections? A distinction is made between the pre and post global financial crisis periods by splitting the sample period at 15 September 2007. As such, the post-crisis subperiod includes the crisis itself. Could this be a key factor that heightens the spillover effects post-crisis? How about spillovers in the aftermath of the crisis, which doesn't include the crisis period? The paper goes on to apply a structural VAR model with instrumental variables to identify US monetary policy shocks. Indeed, the use of unconventional monetary policy with the interest rate at zero lower bound calls for new identification schemes that can identify shocks during both conventional and unconventional monetary policy periods in a unified manner. But the impulse response function in Figure 6 suggests that the US monetary policy shocks have mostly insignificant impact on US prices. I'm wondering what are possible explanations for this finding. So the identified structural shocks are used to assess downside risks. So instead of the usual conditional mean analysis, the paper examines the impact of these shocks on both the median and fifth percentile of real output and investment using panel quantile regressions. I think it would be interesting also to know whether the structural shocks cause a change in the shape of the distribution for investment and GDP growth. Are the distributions now more heavily left skewed? Such asymmetric effects can be assessed by examining a range of percentiles using the same quantile regressions. Given the uncertain recovery prospects across countries, the paper differentiates the impact of US monetary policy shocks between economies facing business cycle expansions versus those facing downturns. It uses a smooth transition function with parameter gamma that determines the probability that the economy is in either state. How sensitive are the qualitative results to different gamma values? Has robustness check been performed? The impulse response functions in Figure 10 suggest the impact of US monetary policy shock on other countries' GDP is not significant in the first year of 4 countries in recession and barely significant in the case of investments. What are some possible explanations for these findings? Finally, a natural extension to this research is to explain the differences in spillover effects between countries in terms of their characteristics. One can consider exposure factors as well as macroeconomic fundamentals. These are the factors which were mentioned in the keynote speech just now. So by including such interaction terms, we could assess the different channels of shock transmissions, as well as which policy measures or country characteristics are better able to insulate countries from spillover effects. And these would be useful for drawing policy implications. Overall, this is a rich paper that is very well executed. It draws out important diverse inferences from data, and it's a very highly recommended reading. Going forward, it is plausible that the COVID crisis could alter past macroeconomic relationships. The senior minister of Singapore was just saying that we don't even know what the Phillips curve looked like now. So hence the need for such data-driven econometric analysis. And I think this conference would be very useful to shed light on how the COVID crisis can affect central banking in this region. Thank you.
Thank you, Professor Chow. Those are very interesting comments and suggestions, I guess.
Thank you.
And I do agree with all your comments and suggestions. I'll open the floor to all the audience now for question. I can see that John has already put a question using the chat box. The question says, while financial spillovers to Asia have increased in magnitude, resilience to external shocks in Asia has also increased. So what extent should we really worry about rising US spillovers? Dr. Elif, I think you can also read the question.
Okay. Yeah. Thank you. Thank you very much. Thanks a lot for the very useful comments. I think maybe I'll touch upon a few. So one question was, why not use the structural shocks that we use in the financial spillovers part directly in the panel quantile regressions when we look at the spillovers. Actually, this is something that we plan on doing, but the key reason is that we wanted to have a longer time series for looking at real spillovers. The issue is that we have these unanticipated shocks for the later part of the sample. And what is nice with using them as instruments in the SVAR is that we are not bound to with the shorter time series that we have for these high frequency estimates of these structural shocks. But they are, it is possible to combine use these shocks as instruments directly in the panel quantile regressions that we're looking at, but to be able to take advantage of a longer time series, the SVAR. And then the second reason is we wanted to have a coherent, framework from which we use to identify several different shocks. So because we're looking at monetary policy shocks, demand shocks, and supply shocks, but at the very minimum, we could certainly show how these structural shocks that we identify are correlated with these SVAR implied shocks, and the correlation is fairly high. I don't know what is, but it is directly used in identifying the SVAR, so there is a high level of correlation. I think on the analysis of the financial spillovers, yeah, you're right. I think we should definitely look at exclude the how results change if we exclude the global financial crisis period itself. So that we'll definitely do that. But again, we are looking at sort of the surprise component of monetary policy. So to the extent that, I mean, that, that still provides us, I think, useful information, even if it was during the financial crisis. Again, you could argue that that's a different, that the financial variables might respond differently, given that it's in the middle of the financial crisis. But it's because we're looking at the surprise component, it's still interesting to include. But again, as the robustness, we could definitely exclude that period as well. Structurally, the impact of monetary policy shocks, the impact on inflation. This is sort of the standard classic, I guess, the price puzzle that a lot of people have, find in these SVARs. So I think, it's, I think you raise a valid concern, but, I think we need to think a bit more about how to address that. Looking at different percentiles of the distribution, again, we could also do that and even estimate, distributions and look at how they have, shifted, that we can do. We wanted to, just use the 5th percentile as a sort of has been used. It's kind of become standard in these estimates of growth at risk, but again, we can definitely do that. Very good suggestion.
Sorry, Dr. Alif, I'll have to ask you to stop there because we are running short of time. Okay. And you can see that there are questions in chat box as well. So you can respond to those questions as well. For other presenters, just be mindful that we are, it's a time, there's a time limit and we need to finish it on time so that others can also get enough time. So in my view here is that my suggestion is once the discussant gives the report, you can just provide an overview of your, if as a presenter, you can provide an overview response to that, but you don't have to give a response in detail. But when you are revising your paper, you can make a proper rejoinder, which we will be going through. So thank you, Dr. Alif.
Thank you very much. Thanks a lot for all the comments and suggestions. Thank you.
Thank you. Our next presenter is Assistant Professor Salam. He will be presenting a paper on the effect of COVID-19 pandemic on monetary policy transmission to financial markets in Bangladesh.
Okay, thank you. Good morning, everyone. I am Dr. Mohammad Abdul Salam. Thanks to all for giving me the space to present my research work on the effect of COVID-19 pandemic on monetary policy transmission to financial market in Bangladesh. Technical problem, maybe. COVID-19 pandemic has adversely affected the worldwide economy, causing a slowdown of business activities and economic contraction, and that reformulated the monetary landscape worldwide. So it generated the higher level of systemic risks, created doubt, devastated economics, heightened the great uncertainty. So it enhance the anxiety of investor to find the safe investment zone for their investment. So it increased the consciousness or anxiety for the investment. So monetary policy, what is the monetary policy? It is the essential tools for every country to reduce the such kind of uncertainty or systematic risks that establish the monetary situation or economic situation of the world. So monetary policy make the proper strategic decision to continue the economic growth. So such kind of COVID-19, most of the economics of the world have reshaped the monetary policy to repair the damaged economics by providing monetary stability. So Bangladesh is not apart from that. Like Bangladesh, Central Bank of Bangladesh, Bangladesh Bank, this is the Central Bank of Bangladesh, has it the monetary policy in response to COVID, such as reduce the policy rate, reserve requirement, repo rate, raising the advance deposit ratio, increase the board money growth rate, etc. COVID-19 and Bangladesh. On 30 January 2002, who declared the COVID is the public health emergency of international concern, and on 11 March 2020 as declared as pandemic. In Bangladesh, on March 8, 2020, in that day, Bangladesh confirmed the first COVID-19. The government of Bangladesh declared on 23rd March as a general holiday that will be implemented from 26 March to 30 May in 2002. That led the closure of government office, private office, courts. That means whole office closed and reduce the banking office hour. But after 30 May, on 31 May, that closure gradually is the lockdown and reopen the government office, private office and courts, and improve the banking office hour. So more than 1 year lasting pandemic silence for economics theory, policy and widespread disruption of the economy. So it is the ongoing silence, not only worldwide, not only Bangladesh, but also the worldwide. So in that situation, for the response of the COVID-19, monetary policy have been adjusted to encounter the challenges and discuss then create new scenario for researchers to examine the effective is the monetary policy for Bangladesh. Monetary policy and financial market. Monetary policy influence the financial market that use the central bank to control the financial market. So financial market is the connecting mechanism between the monetary policy and real economy. So control the real economy. So monetary policy used to control the financial market. So monetary policy transmission to real variable consists two-part process. First process, central bank influence the financial market, then financial market impact on the real economy. So financial market is the snapshot of the national economy. So financial market, we can say that financial market is the barometer of the national economy. So better understanding of the national economy. So it is to understand the transmission of monetary policy or real activity. It is essential to examine the impact of monetary policy on financial market. But due to COVID-19, most of the industry was the hard time because they faced the several losses in the pandemic period, because they cannot continue the production properly, they cannot marketing their product. So investor could not find the safe zone for their investment. So investor were puzzled about their investment that could reduce the effectiveness of monetary policy transmission to financial market. So this study examined the effect of the COVID-19 on monetary policy transmission to financial market that covered the money market, bond market, stock market, exchange rate market in Bangladesh. So this is the general objective. This study addressed the following specific research question. First research question is can the monetary policy effectively transfer to financial market during pandemic period? What is the impact of both emergency and severity of the pandemic on transmission? Third, are the results different for the conventional and unconventional monetary policy? Scope and data. We have selected the Bangladesh case study that represent the developed country case strategy to examine the effect of the COVID-19 on monetary policy transmission to financial market during the period from January 1, 2015 to April 30, 2021. We have two measurements. First measurement is COVID-19 pandemic event defined as a dummy variable that deferred value 1 if the pandemic occurred, otherwise 0. Second measurement is the severity of the pandemic that is defined by daily growth rate of COVID-19 confirmed case in Bangladesh. First, how to measure the monetary policy? First, conventional monetary policy variable that recognize the policy rate sense and announcement of the unconventional monetary policy variable known as dummy variable. So conventional policy rate represent the conventional monetary policy, unconventional monetary policy announcement. We consider the announcement time that refer as a dummy variable that value 1 on date of unconventional monetary announcement and 0 otherwise. So what kind of unconventional monetary policy use, such as quantitative easing, large scale purchase of long-term asset, target reduction in requirement ratio, repo rate, raising the advanced deposit ratio, increase the broad money growth rate, growth target, and so on, are included in the unconventional monetary policy. So we consider the full sample period during the period from January 1 to 2050 to April 31, 2021. And effectiveness of unconventional monetary policy based on the pandemic period from January 30, 2020 to April 30, 2021, where frequently change the monetary policy after the COVID-19 outbreak. So we consider 2 points that full sample period is January 1, 2015 to April 30, 2021. Then second subsample period, that means COVID unconventional monetary policy on the pandemic period that start from 30 January 2020 to April 30, 2021. So why you consider that January 30? Because who declared the 30 January 2002 is a public health emergency of international concerns. According to Bangladesh Bank, Bangladesh Bank said that Bangladesh Bank give the statement that financial market of Bangladesh consists mainly money market, treasury bond market, capital market, and foreign exchange market. So we choose the indicator that represent the respective market may be sensed by monetary policy. So money market, 1 year treasury bond yield represent the money market. Why you select the 1 year treasury bond? According to Bangladesh Bank, gave the statement that 1 year treasury bond included money market of Bangladesh with other instrument. 10-year government bond yield that represent the treasury bond market. Stock exchange return of Dhaka Stock Exchange represent the equity market, and currency exchange rate of Bangladesh against US dollar indicate the exchange rate market. So daily policy rate, 1 year treasury bond yield, 10-year government bond yield, exchange rate of Bangladesh against US dollar and unconventional monetary policy announcement are collected from Bangladesh Bank. Daily stock exchange return data are collected from Dhaka Stock Exchange. Daily COVID-19 confirmed case number are collected from Director General of Health Service in Bangladesh, Health Ministry of Bangladesh. This is the scenario of new confirmed COVID-19 cases. 8 March of 2020, that was the first confirmed case in Bangladesh after gradually increasing the COVID new confirmed cases, and after 21 June 2020, that decreased the new confirmed cases, and finally it is the highest 8 April of 2021, and that is the highest highest new confirmed case on the 8 April 2021.
Sorry, Professor Salam, you have another 5 minutes.
Another 5 minutes.
Yes.
Oh, we have to follow the event study method because policy rate sense usually have many zero value. This is the full sample period. This is the Y represent the Bangladesh 1 year treasury bond yield, daily exchange rate, 10-year government bond yield, and the daily return of stock index. RT recognized policy rate, UAT diners the dummy variable. Sorry, maybe technical problem. Sorry.
Dr. Salam, shall we share your slides here, or is it okay now?
Sorry, Professor. Maybe technical problem.
Okay, do you want us to share your slides here and then you can wrap up, or what do
Interrupt
you
the sharing
prefer?
yes, interrupt the sharing slide.
Okay, so we will share your slides.
Again.
Okay, so please go to the next slide.
So understand, but oh, this is the empirical result.
Okay, so can you please conclude your presentation in the next couple of minutes? Thank you.
Sorry, maybe technical problem. We cannot share the whole slide now.
That is fine. You can just conclude your presentation. Just tell us what are your main findings.
Okay, main findings.
Yeah.
Yes. Just 1 minute. This is the okay. Examine the effect of monetary policy. Full sample period. Examine the effect of monetary policy, conventional monetary policy of financial market. Result for the conventional policy rate has positively significant effect on 1 year government bond yield, 10-year government bond yield, stock index return, and change in exchange rate. Consider the pandemic period. Conventional monetary policy has no effect on any indicator of the financial market. But unconventional monetary policy have effect on 1 year government bond yield and 10-year government bond yield and stock index return. This outcome gives the preliminary indication that conventional monetary policy does not affect since the COVID-19 outbreak, because full sample period impact whole 4 market, but unconventional for considering the pandemic period, conventional monetary policy do not impact on 4 markets, and unconventional monetary policy impact on 1-year government bond, 10-year government bond, and stock interest. Do not impact on exchange rate market. So we can say that unconventional monetary policy are more effective than conventional monetary policy, but it cannot cover the full sample market indicator, because unconventional monetary policy do not affect the exchange rate exchange. So we can see that conventional monetary policy do not affect the market indicator in the pandemic period. So the results show that weakness transmission of monetary policy to financial market indicator during COVID-19 period. Emergence of the COVID-19 has weakened the transmission of monetary policy to some extent, but severities of the COVID-19 pandemic do not affect the transmission of monetary policy to financial market indicator. So what is the causes that weaken the transmission of monetary policy to the financial market indicator? Because investor always try to expect the proper educate a certain policy from the policy making during the pandemic period or uncertain period. But in Bangladesh, it was difficult for the policymaker to respond such kind of situation, because world was hampered for the COVID-19. So market participants do not proper respond to the market policy in normal times because lack of experience. So not only policymaker but also market participants do not proper response. But market participants who are less risk taker keep them sideline because they observe the situation. Second, policymaker design expansionary policy for encourage the participant of the market to engage the financial economic activity. But Bangladesh government first give the priority save the people. So give the lockdown, social distancing policy that deter the give the impediment to proper function of the market. Third, policy announcement, investor resource policy try to find safe high return zone, but globally COVID-19 impact of global economy. So limit the scope for the investment to fight the safe zone. Policy implication. So it can use the Bangladesh Bank to use the expansionary monetary policy at good policy, and this result give the unconventional monetary policy more effective than conventional monetary policy. So Bangladesh Bank give the emphasis on unconventional monetary policy. So Bangladesh can redesign or diversify the unconventional monetary policy and adjust with the other fiscal policy to respond to such kind of distribution of the economy and post-pandemic period. Bangladesh can use the recover the economy in the post-pandemic period to use the unconventional monetary policy. Contribution of the study. This study result of the COVID-19 pandemic, the monetary policy and financial market of developed country. This result represent the developed country case study. So most of the study done on developed country. So this result is a unique result that we can compare the developed country and developing country. So this result give the level of pandemic, emergency and severity. So what is the impact of emergency and what is the impact on severity of the pandemic? So we can see that severity do not impact on Bangladesh economy or Bangladesh market, but emergence of the COVID-19 impact on Bangladesh market, Bangladesh financial market. The outcome of the study will provide the better understanding the reliable evidence of monetary policy transmission of Bangladesh 99 period that guide the Bangladesh Bank to adjust the monetary policy with other policies and for recover or damage economics for the post-pandemic period. Thank you, Shushan. Due to interrupted, you give me the chance to present my paper. I'm sorry, really sorry. Do do not.
That is
share
fine.
my- yes, thank you.
Yeah. Now I will ask the discussant. Who's the discussant? Sorry. Let me see who's the discussant. Also,
Grace.
the economist Shutian. Yeah.
Thanks, Susan. Thanks, John. Hi, good morning, everyone. Let me share my screen. Are you able to see it?
Yes.
Okay, thanks. Good morning, everyone. I'm Shutian from the ADB. It's a great honor to discuss this interesting paper, this very important webinar on central banking. Let me first start with summarizing this paper. During pandemic, actually, global monetary authorities has adopted accommodative monetary policies to support the economy worldwide, within the region and even in advanced economies. Normally, we see conventional monetary policies during the COVID-19, such as a policy rate cut, reserve, including lower the reserve rate required and lower the repo rate. Many of the central banks in advanced economies and also within the region also conducted unconventional monetary policy like a QE type of instrument. So for example, several central banks in developing Asia, like Bank of Thailand, Bank of Malaysia, Indonesia, Philippines, even Bank of Korea, they conducted this kind of asset purchasing programs in domestic bond market to support market liquidity and also to facilitate government financing for different purposes, of course. The financial markets actually, as the Dr. Salam just mentioned, it is very important intermediaries to transit the monetary policies to the real economies, to making credit to the real economy. So this topic actually addressed a very interesting and important topic. So how effective were these monetary policy instruments in transiting financial markets? And then this paper look at different financial markets like money market, bond market, stock markets, and currency markets. This paper actually tries to address three research questions. So the first one is whether these monetary policies introduced by the Bank of Bangladesh was able to effectively transmit to the financial markets during the pandemic period. Well, this is very recent evidence. And then the paper also tries to address what is the impact of both the emergence of the pandemic and the severity of the pandemic on the transmission. I think this is quite new to address, actually, whether the central banks considers how serious the pandemic is. And the last RQ is whether there are some different impacts between the conventional and unconventional monetary policies in this scenario. Some of the key findings are summarized here. So during the full sample period, the paper find that, well, conventional monetary policy, in particular policy rate cut, has positively influenced this 1-year government bond yields, 10-year government bond yields, stock market returns, and the exchange rate changes, while at the same time unconventional monetary policy doesn't seem to have much impacts. This is during the full sample period. And then turning to the pandemic, it seems that conventional monetary policy captured by the policy rate cut doesn't have a significant impact on any kind of financial market indicators, while unconventional monetary policies does. I think this is very intuitive, and then I think this is very consistent with what we can observe in the real market. And then in terms of the emergence and the severity of the COVID-19, the authors argue that, well, the evidence shows the emergence of the COVID-19 actually weakened the transmission to monetary policies to financial markets. I think he means conventional monetary policy. And then the severity of the pandemic actually doesn't seem to affect transmission of monetary policy to financial market indicators. I think all these kind of findings are very intuitive and are consistent with what we can observe in the market. So it seems that the Bangladesh evidence is largely in line with what we can observe in global financial markets. So in general, I found this paper very interesting. And then in terms of the research method, actually, and also in general, the research design, I do have a few comments. So let me start with addressing these empirical models. In the empirical models, actually, there is a baseline model. So daily changes in key market indicators like in bond yields, stock returns, exchange rates are regressed on policy rate changes. This is as a conventional monetary policy instruments and a dummy of unconventional monetary policy announcements. And then this is a baseline. And then when the authors was trying to examine this emergence of the pandemic, there is an additional dummy of the pandemic period. And then when the authors want to check the severity of the pandemic, they also included a daily growth in the confirmed COVID-19 cases and the interaction with the monetary policy instruments. So the research design is very straightforward, but I do have some concerns here, which I hope my comments will help to improve this paper. So in general, this slide summarizes the 4 key tables of the key findings. My feeling is based on the previous methodology I just showed, it seems that the current model can still be improved by incorporating additional explanatory variables. Because if you see all these explanatory powers R square captured by R square is quite low across different models. And then I do think there might be some possible issues related to missing key variables. For example, many of these financial market indicators are affected by a global common financial market factors, for example, like the Fed announcements, the inflation, particularly for bond markets, how strong the US dollar is because it has something to do with the capital flows, and then Fed rates, and then other monetary stances from the major central banks. Actually, they all influence this emerging market central bank actions. So I think it might be useful to include all these kind of global market shocks in the model to capture some kind of common factors that drives the daily market reactions. And then alternatively, you can also benchmark your indicators. For example, you can minus some kind of the common changes in global market movements so that you can capture how the net effect driven by local conditions on your market variations. So there are different ways to address it. And then also you can consider to account for economic fundamentals. For example, there is a release of key economic data like inflation, current account performance, GDP growth number, and then that will also affect the financial market reactions because you are using daily data, daily changes, and then this needs to be accounted too. And then also you may also wish to include some kind of regional major stock market like India. I'm not sure how closely the two market is, but if it is closely linked to one of the major regional markets, I think you also need to account for that. So that is basically on the market model, on the model to include more factors to address this, to explain your daily changes. And then my next suggestion is to add more explanations on your impact on the bond yields and stock returns. Basically, if we control the same set of variables under the same conditions, when the rate is cut, actually the market reaction will be like this: stock market will rise, and the bond yield should be lowered and the currencies should be weakened. This is followed the pricing model and also the currency parity equilibrium. I think I agree with what you observed in your model, particularly during the pandemic. But I think this needs to be further explained in your discussion of the results. Why, when there is accommodated monetary policy announcement and the bond yields actually increased, and then actually currency also increased. So I think this needs to be further addressed. You can see actually you can add some discussions linked to the pandemic. Actually, there is a global oil crisis last March, and then also there is a global wave of central banks cutting rate. So that's why the bond yields was leaning down, but you are finding the bond yield is increased. So I think you need to discuss this a bit more to emphasize why you find this, and then how your results is compared to other evidence from other markets. And then lastly, this is some minor suggestions. I would suggest you might wish to compare to other crises, for example, the global financial crisis, also the taper tantrum, and then to see how in Bangladesh, how during different financial, different crisis time, and then the monetary policy may trigger different market reactions, and then you can discuss the difference. Actually, the nature of all these financial crises are different. The crises are different, so you can further beef up your discussion, and then you can also consider introducing some of the background of what kind of monetary policy that the Bangladesh Bank has been introduced as conventional and unconventional monetary policies, and then how actually within the region and globally how other central banks has been doing, and then what is the position of Bangladesh Bank in responding this compared to other peer central banks. I think some kind of background information will also be important to add more contents information to your paper. So that is largely what I have to help improve the paper, hopefully. And then in general, I like this paper. It's a very important topic, and then good luck with the revision and publication. Thanks.
Thank you, Shutian. There is another question by Dr. John here on the chat box. What underpins the lack of conventional monetary policy effectiveness, low policy space, or weak transmission to the real economy? So that's the only question I had here on the chat. I'll leave it now to Mohammed. Just you have another 2-3 minutes just to respond to these questions.
Thank you. Thank you, John, for this question. What is the underpin the lack of conventional monetary policy, effective slow policy space, or weak transmission to the real economy or combination? Because policy rate do not sense conventional monetary policy in Bangladesh do not frequently sense. It sense after certain period. So most of the time it is has a zero value, sensing zero value. So it is do not the proper. It have limited space to impact the conventional monetary policy on real economy. But if you use the conventional, unconventional monetary policy, it can respond the situation. But conventional monetary policy do not respond the situation because it sense after certain period, So it is the major limitation in Bangladesh.
Thank you, Dr. Mohammed. I would like to now conclude this here, and we have another 15 minutes break. And after that, we can hear from the third paper presenter. Hello, everyone. Welcome back. Okay, we will continue with the third paper. The presenter is Senior Consulting Economist, Peter Morgan. He'll be presenting a paper on monetary policies and financial stress during the COVID-19 pandemic and event analysis study. Over to you, Peter Morgan.
Hey, thanks very much, Susan. This is actually going to be a joint presentation with myself and my co-author, Trin Long. So the title is Monetary Policies and Financial Stress During the COVID-19 Pandemic and Event Analysis Study. Next slide. Next slide, please, Long. Might be having some technical difficulties here. Okay, so the background is first, many studies have examined the effects of the COVID-19 pandemic on economic growth, on livelihoods, inequality, firm activities, labor markets, and international trade. And a very large number of studies have also looked at the effects of COVID-19 on stock returns, volatility, oil price shocks, and exchange rates. And the literature also examines the effects of government's non-pharmaceutical measures and economic stimulus packages on economic activities, especially the reaction of the financial market. However, to our knowledge, there are no studies examining the effects of government stimulus packages, especially monetary policy steps, on financial stress. Next. So in this paper, we construct a daily financial stress index, which consists of measures of stress in three markets: the banking market, these are basically bank stock prices, the foreign exchange rate market, and the stock market for 15 advanced and emerging economies. And using event analysis, we examine how financial stress is affected by the announcement of financial policies, and in more detail, whether there are any different effects of different kinds of instruments, i.e. Interest rates, reserve policy, lending operation, asset purchase, etc. Next. So in terms of our contributions, this paper adds to the literature on the effects of government financial policies on financial stress in several ways. First, although there are a lot of studies on the effects of COVID-19 on stock market returns and volatility, exchange rates, and banking, none of the previous studies examines the effects on overall financial stress, which reflects the stability of the whole financial system. Second, we focus on the effects of different types of stimulus policies that governments implement to counter the potential effects on financial stress. And some of the studies had looked at the effects on the financial market, but not on financial stress or overall financial stability. Next. Okay, just to discuss briefly about financial policies. During the pandemic, overall fiscal authorities, relevant government agencies, and central banks have reacted quickly on a massive scale. Central bank monetary policies included providing accommodation, liquidity assistance, and credit provision, supporting market functioning and foreign exchange market intervention, while fiscal authorities and other government agencies policies included macroprudential policies, fiscal measures to support bank borrowers, other measures such as crisis management policies, public debt management, etc. In this study, we focus on the impacts of policies to provide accommodation, liquidity and credit in the banking system, policies to ensure market functioning, foreign exchange market intervention, and macroprudential policies. Next. And this table summarizes the various kinds of policies that were covered in our sample of 15 countries. You can see there's quite a large number of them, and these are divided into the ones I mentioned: asset purchases, foreign exchange intervention, interest rate changes, lending operations, reserve policy changes, macroprudential policies, and support of borrowers and others. Next. And then to give some background on the literature, there has been a huge number of studies which looked at the effects of COVID-19 on stock returns, et cetera. And also studies have looked how government containment and government stimulus policy affects the operation of financial markets. However, there's not much discussion on whether government agencies and central banks should intervene or not to respond to the crisis. The implications of such interventions are still open questions. So on the positive side, we had comments from Sedinov 2021 saying that the probability of systemic risk would be reduced due to the implementation of these various measures. Next. but on the other hand, there's a possibility that some of the financial policies could actually contribute to financial instability and systemic risk. So, for example, Rajan, Della Riccia et al. And Adrian and Shin suggests that financial institutions may substitute low-yielding safe assets for higher yielding risky assets or increase their holdings of risky assets. Ising suggested that financial policy during the crisis may increase moral hazard incentives to take on more portfolio risk. Acharya and Euromazer 2007 suggests that financial policies may encourage financial institutions to engage in herding behavior to increase the chances of future assistance. And Cesabianchi and Ribuki suggest that systemic risks may be worse if financial policies are implemented in an uncoordinated manner due to offsetting or amplifying effects of different policies under different circumstances. Next. And Haddad et al. Find that the US Federal Reserve's quantitative easing seems to have been effective in boosting stock prices and lowering spreads in the US. Naidu and Ranjini find evidence of reversals in stock returns, mostly following the first stimulus payment in Australia. Rahman et al. Find that in the case of Austria, among two stimulus packages related announcements, the market reacted positively to the job keeper package. And the results also suggested that the smallest, least profitable and value portfolios suffered most during the pandemic. So now let me switch to my co-author, Trin Long, who will talk about the empirical approach and the results. Long?
Yeah, thank you very much, Peter. I will present the empirical approach and the empirical result. In this study, we use the empirical event approach to study the effect of various events on the financial market. The main idea of this research is to assess the effect of policy announcement through the regression of changes in some financial market price or events event dummies, while at the same time controlling for all the other relevant news available with the period under analysis. We follow the literature to adopt the event study approach to examine the effect of different government stimulus announcement on the financial stress during the period from January to 2019 to the end of May 2021. The event date is denoted as T0 and is defined as the date the government announced a financial measure or package. In this study, we consider the event windows of 5 days before the announcement and 5 days after the announcement. Here is our equation, benchmark equation. The dependent variable is financial strength index, while the independent variable, including the dummy variable, we take value of 1 if a financial policy is announced on 80 and 0 otherwise. We also control for 5 days before the announcement and 5 days after the announcement. And then we also control for other variable like the non-pharmaceutical measures and a number of newly identified case on in country I on beta T. In this study, we adopt 2 methods to identify an event date. The first one is we use, we call it unrestricted method. That means the day on which one or more financial measures are announced. That means we don't care about what kind, whether the announcement of, because many countries announce several policy in the same day, but in this case, we just let it go to account as an event day. The second way is we call it as a restricted method. We try to disentangle effect of a given policy on financial stress. In the approach, an event day is identified if only one type of policy was announced in the window from 2 days before to 2 days after the event. First of all, to examine the effect of an asset purchase program, we do not identify days when other policies such as foreign exchange intervention or macroprudential policy was announced during the period from the 2 days before and after the 2 days after that day as event date. And we also try to disentangle the effect of the spillover of financial stress from the other countries. We use the above and IMAS approach to eliminate the spillover of financial stress from other countries to the variation in the financial stress of a country. We will try to use the several other ways to remove the spillover across the countries, and the result is quite the same. On the data for policy announcement, in last years, there are a lot of police agencies try to taking up what type of policy announcement for own countries. In this study, we use a turnover database on the provide information government financial measure to respond to COVID-19. The first database is collected by and updated periodically by the Bank of the BIS. In this database, they cover central bank monetary policy in 4 areas: the providing accommodation, liquidity assistance, and credit provision, supporting market functioning, and foreign exchange market intervention. But however, because there are a lot of the other measures, financial sector financial measure also affects the effectiveness of the intervention. So we use the second database, One Bank Financial Sector Policy Response Database. This database covers a variety of policy, including both monetary policy and fiscal policy, issued by not only by central banks but also by Ministry of Finance as well as the relevant government agencies. The One Bank database covers quite broad policy intervention. But in this study, because we are more likely to focus more on monetary policy, so we use the BIS database as our main database for 2 reasons. The first one, we focus more on the effect of monetary policy on financial stress, and we also feel that the BIS database seem to be more comparable because they contrast quite a little bit cleaner than One Bank database. But we also extensively use the One Bank database because BIS database do not report some policies as a micro and macroprudential policy, and they just report the policy announced by the central bank, while many financial policies issued by Ministry of Finance or other government agency also related to financial stress. So in addition to BIS classification, we adopt 2 other classification by the World Bank. That means the macroprudential policy and support the thing for borrowing policy. For this study, we use policy implemented in 15 countries. And to calculate measuring the financial stress index, we measure three sectors. The financial stress index based on the variance weighting on 3 sub index from the banking sector, stock market, and foreign exchange market. For example, in the banking sector, stock index, we construct 3 indicators, including the beta for the banking sector, negative bank equity returns, and bank equity volatility. But in the exchange rate market, we use the volatility of the foreign exchange market, we use a GATCH process to measure the volatility of the market. we normalized all the variable before aggregating into one to avoid the difference in measurement. Here's the financial strength index and the announcement, and we see that most of the announcement is on the early day of the crisis or the pandemic. I mean, in about March. Most of country announced the financial in the March, and it's especially in the March and April, there are a lot of countries, even in developing country, they also announce a lot of the policy to counter the effect of the crisis. And we see that whenever there are kind of announcement, they're a little bit higher in financial stress in that country. Some countries adopt a lot of policies. For example, like in the USA, they use a lot of policy instrument to counter the effect. But some country in developing country like Indonesia, they also use a lot of measure to counter the effect of the pandemic. And here is our result. This is our benchmark estimation. I mean, in this estimation, we didn't we use the unrestricted method to estimate to estimate the effect of financial. In the first one, we see that the policy in fact have increased the financial stress index in a country, and then but it's not only asset purchasing, foreign exchange rate, and lending operation and reserve policy have effect on the announcement of such policy have effect on financial stability. And the other thing is the policy, the announcement of policy have only caused the increase in financial stress index in only about 2 days, and after 2 days, in most of the case, the policy, the financial index become stabilized. I mean, it's not increased anymore, and the effect of the announcement is seem to be effect of have impact on financial stress, and because for brevity, we didn't present the policy in a few days before the announcement. But we see that the financial stress index is rather high at the last 3 days before the announcement of asset pricing in some policy. So we think that policy might not be effective, but we need to further examine because in this case we use a very unrestricted method to identify an event. But we also find that the effect of daily new case or other non-pharmaceutical measures don't have effect on financial stress index. And here's because we also use a multiple announcement. Sorry. Yeah, and then in this case, in this table, we present only. We are presently our restricted approach, and we see that in some case, for example, asset purchase don't have any effect anymore, and in most of the case, the announcement don't have effect on financial stress index, except for asset purchasing. They have an effect on the second day after the first day after the announcement, and the third day after the announcement. And the lending operation is have a very long effect after the announcement. But reserve policy, for example, usually have effect on financial stress index in the first day. In the announced day, but in the other day they don't have any effect on the financial stress anymore. And we also found out that confession for days before the event days were positive. I mean, announcing a financial measure might have responded to the increase in the financial stress index. So financial stress index was still high on the event day and the day after, but lower estimate in the subsequent days. So get that the effect of announcement fade away over time. That means it may indicate that government financial measures take some time to work out fully discounted. And then we look at the effect of announcement on three sub market. We use in this one we use in this table we use restricted approach, and we see that for bank component the effect is only in one the day of announcement and the day after announcement, and the coefficient is lower in the second day. But for exchange rate component, we see that the effect is still very high in the few days after 1 or 2 days, 3 days after the announcement, and this only weakened in the 3, 4, or 5 days. But the stock market don't have any effect on the first 3 days, but it's have a small effect on the last day, but the fourth day. But we doubt about this reason a little bit. And then yeah.
Can you please conclude your presentation? We're running short of time now.
Yeah, and then we try to eliminate the spillover, and we see that the result is quite consistent, but the effect of policy is a little bit lower. So maybe because of spin back of the financial threat from one country to the other countries. And then in this paper, we examine the effect of announcement on financial policy, and we found that the announcement of financial policy on any type increased the financial threat on the day the policy was announced, but the effect faded away in 1 or 2 days after that. Not all financial policy announcement caused an increase in the or decline in the financial stress. The response of financial threat to the announcement of financial policy and type is lower when we remove the effect of foreign financial stress from the domestic financial stress measure. And we also follow that the announcement of financial policy affect the financial stress in most of country in our sample, but at the different rate of and time lag. Yeah, thank you very much.
Thank you, Long. I'd like now the discussion to have a discussion on the paper. Associate Professor Chinmaya Behera.
Yeah, Professor Susan, good morning. My slides are visible?
Yes. Can you just increase the size of it? Yeah, make it, yeah.
Right. So good morning, all of you. I'm Dr. Chinmaya Behera from India. And first of all, thanks to the organizer for giving the opportunity to be part of the workshop as a discussion. And the topic is given to me is the monetary policies and financial stress during the COVID-19 pandemic and event study analysis. So first of all, congratulations to the authors. They have done really in-depth studies. So for that, the congratulations. Now, coming to the summary of the manuscript, basically the manuscript studies or investigates the impact of monetary policies on financial stress index for the 15 countries from the data set from 1st April 2019 to 30th November 2021. And using event study analysis, the study finds that the policy announcement increases the financial stress index on the day of the announcement, and the impacts fades away eventually. Further, the study finds that policy announcement affects financial stress in most of the countries with a different degree. So this is the brief summary of the manuscript. Now, what are the innovative in this manuscript? There's a two major innovative what I found from the manuscript. The first thing is the creation of the financial stress index. That is one of the innovative ideas of the manuscript. The second thing is the policy announcement. The the monetary stimulus and its impact on the financial stress index is also another addition. That is the innovative idea of the manuscript. Now, studies, out of curiosity, I have made certain observation, both minor and major observation. So coming, the first thing is authors consider equity market, banking sector, and foreign exchange market to develop financial index, stress index. However, there are also other markets such as bond market that also prone to financial stress due to policy announcement. So author have not considered that sectors. Now, the second observation I made is theoretical analysis. What are the theoretical analysis about the impact of stimulus on the financial stress in existing literature? So that is also what I found is missing from the manuscript. A second thing is that during COVID-19, both fiscal and monetary stimulus might have affected financial stress. For example, we believe that the stimulus, financial stimulus, have a different effect than the monetary stimulus, but only the author have considered the monetary stimulus or the policy announcement declared by the monetary authorities. However, the fiscal stimulus is missing. Now, the data set mentioned in the abstract as well as the empirical section is not kind of sync. So there's some discrepancy in the data period mentioned. Second thing is the channel of transmission. So how this fiscal stimulus, monetary stimulus is transmitting to the different sector, maybe the foreign exchange, maybe the equity market, or maybe the banking sector. That has to be discussed in the manuscript. So whether it is kind of directly impacting or indirectly impacting, that has to be there. Another thing is there's always a league-lag relationship between the stimuluses. For example, the monetary policy takes time to get impacted on the financial stress index or any different financial sector. But however, the fiscal stimulus has a direct impact or immediate impact. So there's some sort of lead-lag relationship also exists. That also you need to discuss in the manuscript. And another thing is whether the author is considering the stimulus, monetary policy in same way, a similar way. So whether they're considering the stimulus and policy announced by the monetary authority, that conventional monetary policies are all same. So there's no distinction is made in the manuscript. Now, the second set of observation is logic behind the selection of -5 to +5 as the event window. See, in the existing literature, most of the studies, they consider +10 to -10 and +30 days to -30 days. The reason being the lower the event window, the higher the bias result because of the daily observation which fluctuates in the larger extent. Now, the seventh one is what basis 15 countries are selected. So since in the presentation, author mentioned is the advanced countries and the emerging countries, but there are other advanced countries as well as the emerging countries. So why only the 15 countries they have selected? Now, the next is the firm-specific events such as size, value of the sector or company might have impacted financial stress index. So basically, we are talking about the Fama-French factor model, 5-factor model. So there should be some mention regarding the firm-specific events and its impact on the financial stress index. Now, a descriptive statistic also gives an idea what are the nature of the variable that is also missing from the manuscript. Now, author claims that monetary stimulus is not effective to stabilize the financial market. There's one of the major claims they made that monetary stimulus is not effective. But what could be the possible reasons? What is the alternative ways to deal with if there is an uncertainty like COVID-19 pandemic? Now in table 7, result table 7, it is observed that policy announcement in China is not statistically significant. Whatever the policy announcement made in China during the COVID-19, so it's showing that the statistical insignificant result. So, but any reasons behind that? What could be the reasons behind the insignificant result in case of China? So this is the major observation. Now coming to the minor observation, some literature is quoted in the main text but missing in the reference section. For example, Rahman et al. In 2021 is missing in the reference section. And some literature is mentioned in twice in the reference section. For example, Chang et al. In 2021. What are the values in the parentheses in the result table? So this is the minor observation I made. So by and large, there's a very good, interesting study. This manuscript is quite interesting to read and innovative. And I hope the authors will address all those issues. With this note, best of luck to the authors, and thank you.
Thank you, Professor Behera. Any questions from the audience? I don't see any question in Q&A. Okay, so no questions. So if there is no questions, suggestions, then I will simply just conclude here. And if Peter Morgan wants to just provide any feedback or on the comments he received from the discussion, then you have a few minutes there.
Okay, thanks very much for the comments, which we'll certainly take into account in our revisions. One of the main questions was, why do we not consider bond markets and commodity markets as other contributors to measures of stress? Certainly some different specifications of financial stress do include bond markets, so that's something we can look at. In terms of the theoretical analysis, I think probably we can cite some papers in that regard. As far as the timing of the various policies and the effects, I think one has to keep in mind that we're looking at the impacts on markets as opposed to the real economy. So I think issues like channel of transmission are not so relevant. And also in terms of lead and lag relationships, I think although there might be a lag of monetary policy effects on the real economy, that would not necessarily be the case for its effect on financial markets. In terms of firm-specific variables, I don't see how that's relevant, because we're not really, we're basically looking at a countrywide and financial market data. So maybe in the case of banks, there's something we could look at there, but in general, we're looking at fairly broad measures. As to why policy announcements in China were not significant, I have no answer on that. But perhaps Long has some additional comments.
No, we will conclude there, and because we are running short of time now, and we'll move to the next keynote speech. I'm really honored to welcome and invite Dr. Zheng Liu, who is a Vice President of International Research and the Director of Center for Pacific Basin Studies at the Federal Reserve Bank of San Francisco. It's all in the board. You can now share your slides, Professor Liu.
Can you see this?
Yeah, great. Thank you.
Okay. Well, thank you, Susan, and thank you, John, and other organizers for including me in this great program. All I'm saying here is just my own view. It doesn't represent the Federal Reserve Bank of San Francisco's view. I'm going to talk about inflation today. It's on everybody's mind, in headlines everywhere. and I'll also provide some historical perspective and addressing some concerns about a possible repeat of the great inflation experience in the 70s. So if you see this graph, this will not surprise anybody. Inflation has surged since the start of this year. Both headline and core inflation have risen substantially, and the CPI inflation has actually reached the 30-year high to over 6%. And by any measure, inflation has been running well above the 2% target of the Federal Reserve. And you can think of a few factors that might be behind this increase in inflation. You can think about the demand and the supply are both driving inflation increases. On the demand side, there's of course the pent-up demand from COVID recovery. People have been staying home for a long time, and they really wanted to go out and shop. And also there's the rotation of demand. When people are locked down at home, they cannot consume services like leisure, hospitality, travel. So they switch to goods. A lot of people are buying durable goods, large screen TV or computers or, treadmills. And that drove up the prices of those durable goods and cars in particular. And the other side of the demand factor is from the income. The pandemic is a strange recession. It really did not reduced income of a lot of people very significantly, and partly because a group of us, like people here, all have the capability of working from home, and we have a steady paycheck flows into our bank accounts, even we are working from home. And for those people who did need help, like the frontline workers or some workers who lost their jobs because of COVID disruption, very aggressive fiscal and monetary policy have provided support for their income. In fact, you observe in the US, saving actually increased substantially during this period. So these factors are all supporting demand, while at the same time, COVID has disrupted the supply chain. We have seen the shipment rate has skyrocketed. The container ships prices each per container has doubled and quadrupled and still remain elevated. And we have seen surges in commodity prices, and we have seen labor shortages, especially in context-sensitive sectors. So you can find a lot of factors you can dig up, but in a nutshell, the increase in inflation, in particular this year, are largely accounted for by those COVID-sensitive sectors' price change. The price declined initially during the pandemic in the early phase of it, and then now it rebounded. And this is a broad categorization. Some sectors are not really sensitive because they don't require much contact, and some other sectors are. And the COVID-sensitive sectors' inflation are driving most of the recent increase in core inflation. A more relevant question is the concern that, will the high inflation stay? How long is it going to last? Are we going to go back to something like the great inflation in the 1970s? So this question has been on the mind of policymakers as well. So let me address this parallel and differences from the 70s experience. So inflation in US history has gone up and down. In the 70s, we have seen double-digit inflation. And then since the mid-80s and early 90s, inflation has remained stable. at around 2%. And the recent run up is sharp, but not in particular extraordinary, especially compared to the double-digit experience in the 70s and early 80s. So to think about the possibility of a further increase in inflation and the persistent increase in inflation, we should keep in mind a few factors. Now we have something different from the 70s. Here are a few factors, main factors that are different. We have different labor market institution. In the 70s, if you remember, there's a large share of private sector employment, they were unionized. There's a large union presence, and the union negotiated wages are often indexed to cost of living. So when there is inflation, wage will rise automatically. And when wage rise, businesses pass through that increase in labor cost to price increase further. And this wage price spiral was very important in driving up inflation observed in the 70s. Now we have a much less presence of a union, and there's a very few wage contracts that are automatically indexed to cost of living adjustment. So that wage price spiral is no longer there. And the second factor is inflation expectations have been better anchored since the early 90s. In the 70s, when actual inflation rises, people expect more inflation to come, and they believe this is going to last for a long time. And then household would ask for higher wages to compensate the price increase, and the businesses will pass through that wage increase to prices. And they are not afraid of losing market share because everybody is expecting higher inflation, and every other business is raising their price as well. So inflation expectations, if unanchored, can drive up actual inflation. And now we have better anchored inflation expectation. The third issue is a little bit like an academic issue, but it's important for the inflation process as well. How we measure potential output, how we measure equivalently the natural rate of unemployment is important. In the 70s, there are many academic studies that shows that in the 70s, the central bank, the Fed in particular, did not do a good job in estimating the natural rate. They thought the natural rate was low, natural rate of unemployment was low. So they thought there was some room to improve the employment situation. So they continued accommodated policy despite increasing inflation. Now we have a much better sense of those measurement issues. So I'll just elaborate a little bit on those lines. And an important theory behind the inflation process, the Phillips curve relation. It's a relation between inflation and unemployment. Typically, it's assumed to be negative relation. And this is an estimate from Samuelson and Solo in the 60s. So when the economy is in expansion, unemployment rate is low, so go from A to B, then inflation will go up. Vice versa, when the economy is in recession, unemployment rises, inflation goes down. So this relation has been holding in the 60s, but not in the 70s. So if you see this, this is the average inflation and average unemployment in each decade, in the 60s, in the 70s. In the 60s, you see this, a very significant negative relation between inflation and unemployment, as Phillips curve theory is predicting. In the 70s, the correlation becomes positive. So that cast out on the standard static Phillips curve theory. And what might be explaining this positive correlation? You can think about this inflation expectation as one factor that has shifted the Phillips curve. Say, when the economy goes to expansion from A to B, unemployment declines, inflation rises. But if people expect more inflation, it goes the inflation expectation is high, household want more wages, business will pass through the wage increase, price increase. So the Phillips curve will shift and end up with something like a point C with high unemployment, high inflation. That seemed to be behind the Phillips curve. And of course, the natural rate of unemployment is also a shifter of the Phillips curve. What matters for inflation is not the unemployment rate itself, but the gap between the actual unemployment rate and the natural rate. So if natural rate changes and the Fed does not understand that, so they assume natural rate hasn't changed, then the actual Phillips curve will be shifting while without being detected by policymakers. So let me further elaborate on the wage price spiral briefly. In the 70s, unions in private sector is very important. It was like 25% of total employment was unionized, and now it's like 8% or 7%. So it's much less important. And also wage contracts within the union sector, the wage contracts in the 70s were automatically indexed to price changes, to the cost of living changes. But the share of COLA adjustments in the 90s have become much smaller. And keep in mind that this is the share of union contracts that are COLA indexed, and unionization rate has declined substantially from 70s to 90s. So the actual COLA adjustment is much less important than this share shows. And as a consequence, you can see the correlation between wage growth and inflation was very high in the 70s and early 80s. Before 1985, the correlation was above 90%. And after 95, the correlation fell to under 20%. So the wage price spiral has been broken. And another factor I mentioned was inflation expectations. So if you look at the financial market, the investors have priced in some price increases in the recent period. There's especially the next 5-year expectation from financial market has risen substantially. And the longer term expectation has not increased so much. And the household also expect higher inflation, especially at the short term, like a year ahead. And the 5 to 10 year ahead, the expectation has increased, but not out of line with the historical average. So compared to the 70s, the household expectation rose much more sharply than it has now. And the increase in recent periods is similar to what we saw in before the Great Recession in 2008, when oil price and commodity price in general surged. And in fact, there's a correlation between commodity price and household expectations, because if you look at commodity price index from the pandemic trough of April 2020 to now, it has increased more than 60%. So in the economic letter article, I and my co-authors estimate the relation between household inflation expectations and commodity price changes. And we do find that household expectations of inflation react to commodity price changes significantly. And on impact, 60% increase in commodity price that we saw from last year, on impact can raise the 1 year ahead inflation expectation by 20 basis points. It doesn't look that big. And 5 to 10 year ahead inflation expectation rose even less. But in the pre-2000 sample, the increase was more significant, suggesting that over time, the inflation expectation have been better anchored. And of course, the inflation expectations are persistent. It's not like one-time commodity price increase has a one-period effect on the expectations. It can have a lasting effect. Say one-shot increase of commodity price of 60% can raise inflation today and tomorrow, and so on. So that persistence will imply a larger cumulative impact. And we estimate that a 60% increase in commodity price would have increased inflation expectations at the 1-year horizon by about 1.8 percentage point. The actual increase in the Michigan survey of the 1-year expectation was about 2.8%. So it's like, you know, a large fraction comes from commodity price increase, and 5 years is a little smaller. And so I also want to emphasize that this is important. The inflation expectation is an important factor to keep in mind, because once inflation expectations are unanchored, it is very hard to put inflation back into control. And so the policymakers have been closely watching this indicator, the financial sector indicator, household expectation, business expectation, and so on. Finally, I want to discuss briefly about the measurement issues of potential output or natural rate of unemployment. The potential output depends on two things: employment and productivity. How many people are working, and how productive, how efficient each worker is. So in terms of employment, it is closely related to labor force participation. And we have seen a large drop in labor force participation rate during the pandemic. The prime age workers, the labor force participation rate has declined sharply from 68% to 65%, and overall labor force participation rate also dropped sharply. And over this past year and a half, it has returned somewhat, but not to the pre-pandemic level. So it is still there. So it's not clear whether labor force participation rate will return to the pre-pandemic trend. There are some concerns there because there are some people who took early retirements, and it's very hard for people once retired to come back to labor force. It's not clear whether they'll do that. And there are also workers who are reluctant to go back to labor force because of child care duties, and also because of concerns about infection risk. So we're closely watching this and try to update our forecast based on more recent data. And the other thing is the productivity. So we have seen the 70s at the sharp productivity slowdown, and the Fed underestimated the slowdown in the productivity. So they thought there's room to run. The economy, underlying economy is strong. Productivity growth was actually higher than this. You know, they thought it was higher than its actual productivity. And so they think the actual output growth should be high, and that led to run up of inflation. And we saw, you know, after this 1 decade increase in productivity from 95 to 2004, productivity has slowed to this lower rate. The dashed line is the average post 2004. And during the pandemic and shortly after, productivity has rebounded. The question is how long lasting this rebound will be. You know, it could be a one-time effect coming from capital deepening. It's like businesses are buying computers and other equipments, trying to equip workers working from home, or they're improving their telecommunication capabilities to accommodate all this, you know, lack of travel. And that can drive up labor productivity temporarily, but over time it may not. There's a more optimistic view that the pandemic might stimulate the incentive to adopt new technologies that can substitute workers, especially workers in the context-intensive sectors. So robots, for example, can perform some risky tasks, but they're not afraid of being infected. They could be infected by some different virus, but not this COVID thing. So the pandemic might have stimulated the incentive for automation. There are some evidence of that, but the remaining question is how big that effect can be on productivity going forward. So let me just wrap up by this 2 takeaway point. Basically, we have seen inflation running up well above the target, and we don't think the inflation can come down quickly. So it's unlikely to go away in the near term. But at the same time, I think a repeat of the great inflation of the 70s is unlikely for these reasons, 3 reasons. We have a different labor market institution. There's no wage price spiral working anymore. And inflation expectations have been better anchored than the 70s. And we also understand the natural rate estimates better. We still have some challenges to figure out exactly where the labor force participation rate is going or productivity is going. But we certainly understand that those trends are very important for the inflation process.
Thank you, Professor Liu. That was a very pleasant talk. I can see John has raised his hand. John, you can continue with your question.
Yes, thank you very much, Zhang, for this presentation. I have 2 questions. So the first one is that you've indicated that inflation is obviously returning due to a number of reasons. Firstly, addressing the pent-up demand due to the pandemic, and also it's related to impaired supply chains, which are of course recovering somewhat. But I think it's important to understand the relative importance of which factor is driving inflation, whether it's more on the pent-up demand or more on the supply disruption. Because I think that if interest rates would increase too prematurely, it could actually have a worsening effect on the reparation that are underway on the supply side. So that's one question, whether it's more on the pent-up demand or whether it's related more to the supply side disruptions. The second question, of course, which relates to the earlier presentations that were made today, is what all this means for the Asia-Pacific region. Of course, inflation expectations and developments in inflation in the US are of key importance for the Asia-Pacific region, to the extent that they will lead to monetary policy adjustments in the US, which would have obviously implications for the region here. So I wonder what your thoughts on those 2 issues are. Thank you very much.
Should we collect more questions, or should I respond to that?
You can respond to that, Professor.
All right, John, those are great questions. I think in terms of your first question about the demand versus the supply, which is more important, I think that it's still a data issue. From what we have observed so far, we have seen both effects are showing up. The demand effect seem to be pretty more persistent than the supply side. The port congestion, or this shipment rate, the high increase in shipping rate, those can be alleviated. Those can even reverse. Commodity price rise, this oil price, those are usually short-lived. But I think the demand side effect is more of a concern because it's persistent. If the rent increases, then it's going to have a long-lasting effect on overall inflation, because housing is an important factor. And similarly, if other categories of demand is continuing to increase especially with the expansionary fiscal policy, we might have to deal with the persistent inflation problem. And that also has implications for the monetary policy normalization, how fast policy should normalize. If inflation is really continue to rise more than expected, and remain elevated for a few quarters, I'm sure there will be discussions about revisiting the policy normalization process. And that linked to your second question about the spillover to EMEs. What the Fed does certainly has consequences for the global economy. As Professor APAEA was pointing out in his presentation. I think it's a revisit of the previous experience during the taper tantrum. It's like what the Fed is trying to. There are two arguments, right? What the Fed does certainly has important spillover effects, but the Fed does make its policy for good reasons, is to improve the U.S. economy or stabilize U.S. economy and strengthen the recovery and stabilize inflation. So if the U.S. economy is stronger, then there will be higher demand for products from the rest of the world. So that's also a beneficiary to other countries. But of course, on the capital flow side, this external debt, especially for more vulnerable countries, the capital outflow might cause financial stability issues. That said, I think they have other instruments they have used before to deal with the capital flow issues, like a capital control policy. They might deploy those policy in combination with monetary policy to respond to the U.S. normalization.
Thank you. I can see a hand raised by Dr. Behra.
Am I audible?
Yes.
Yeah, just a supplementary question to Mr. John. The thing is, higher inflationary expectation leads to the higher interest rate. And since the pandemic is not yet over completely, so can you, Professor, throw a light on what could be the possible market, basically in emerging countries?
Sorry, I think you were cut off for a moment. I didn't get the question.
Right, so I just repeat the question. Question is, the higher inflationary expectation leads to the higher interest rate, right? And since the pandemic is not yet over completely, so what could be the impact on the financial market in emerging sector due to this?
Yeah, I think that's the same question. I tried to answer John's question. The second question is similar. The Fed policy, this is my personal view, by the way. I think the Fed is trying to do its best job in terms of gauging the inflation going forward, and also the economic recovery, and then decide the pace of normalization. It's a data dependent, in other words. And now there's a lot of uncertainty about where the economy is going, where inflation is going. There are upside risks. Inflation might continue to rise, driven by those persistent demand, and the expansionary fiscal policy contributing to that demand. And it could have, it also has downside risk. It's like, the supply chain bottleneck might be resolved more quickly than we thought, or the energy price come down more quickly than we thought. And those factors can contribute to declines in inflation, or even, another wave of COVID comes out and that constrain demand. So people have another lockdown. I hope that doesn't happen, but no one can rule that out. So a lot of uncertainty remains about the inflation and the growth outlook. And this calls for caution in terms of the changing policy or changing the pace of normalization. If you don't know what's going on and where you're heading to, and in other words, the future is very foggy, you don't really want to make drastic adjustments to the policy. and you want to proceed with caution and wait out this uncertainty. When it becomes clearer, then you can act more decisively. At this point, I think gradualism and being cautious is warranted.
Thank you. Is there any other question from the audience? Okay, no question. Thanks a lot for your nice talk. We will conclude in today's session here, and we will be meeting again tomorrow. Over to Dr. John, I guess.
Yes, thank you very much, Susan, and thank you to all of the speakers who presented today. As Susan has said, we will conclude today's part of the conference now, and we will start again at 11:30 a.m. Tokyo time tomorrow. So thank you very much, and we will see you again tomorrow. That's all for today. Bye-bye.
Thank you.